Welcome back, focused learners. Okay, so today we're tackling a classic business mystery. How on earth can a highly profitable company still run out of money and end up bankrupt? Well, the answer isn't sitting on the income statement. It's actually hidden deep within the statement of cash flow. For today's explainer, we're going full masterclass mode. We're going to detail the exact step-by-step calculations you need to take a company's accrual-based financial statements and mathematically reconstruct its true, undeniably real cash position.
Here is a super quick look at our roadmap. We'll start with the cash reality check, break down the 3 cash pillars, dive into the direct and indirect methods for operating activities, tackle the investing and financing math, and then wrap it all up with the final equation.
All right, part 1, the cash reality check, defining our lifeline. Look, we all know profit on an accrual basis absolutely does not equal cash. Accrual profit is full of promises to pay later or expenses we literally haven't settled yet. But for our calculations today, we only care about hard liquidity. We're talking currency in hand, bank balances, demand deposits, and short-term liquid investments, minus any bank overdrafts. This definition right here is our absolute starting point. If a transaction doesn't touch one of these specific accounts, it does not belong in our math, period. Moving right along to Section 2, the 3 cash pillars, organizing those flows. To keep things from devolving into total chaos, accounting rules require us to meticulously sort every single cash transaction into one of 3 specific buckets. First up, operating activities. This is the principal revenue-generating lifeblood of the company. Second, investing activities. Basically the cash we use to buy or sell long-term assets. And third, financing activities, which shows exactly how the company raises its capital or pays it back, impacting those long-term liabilities and equity.
Next up, Section 3. Operating activities, specifically the direct versus indirect math.
So, we've actually got 2 completely different ways to solve this operating cash puzzle, the direct method and the indirect method. The direct method is exactly what it sounds like. We're tracking actual physical cash movements, literally listing out the cash we got from customers and the cash we handed over to suppliers. The indirect method, though, that's a reconciliation. It's like forensic accounting, where we reverse engineer the profit, stripping away all those non-cash illusions to reveal the cold, hard cash beneath. Both methods get you to the exact same final number, but the mathematical journey is totally different. Let's detail the calculation for the direct method first.
Let's really detail this out. If you want to know what you actually paid suppliers, you can't just glance at cost of sales. We have to strip away the accruals using a precise 2-step calculation. Step 1. Take your cost of sales, add your closing inventory, and subtract your opening inventory. Boom, that calculates your total purchases for the year. But wait, did you actually write a check for all those purchases? Probably not. So step 2, take those purchases, add your opening trade creditors, and subtract your closing trade creditors. That final number, that is the absolute undeniable cash you handed to your suppliers.
Now, if you want to visualize that exact same math, we can build out classic T-account ledgers. To figure out the cash received from customers, you set up a revenue or income account. You drop in your opening and closing accrual and prepayment balances, plug in that comprehensive income figure, and whatever number perfectly balances the account, that's your hidden cash figure. It's a really elegant mathematical balancing act.
Let's look at a real example using Bamboo Brewhad. They reported sales revenue of $35,000. Sounds great, right? But the notes tell us their accounts receivable actually decreased by $1,300. Think about what that means. Customers didn't just pay for this year's $35,000 in sales, they also paid off $1,300 of past debt. So when we adjust sales by that decrease in accounts receivable, we get our true, mathematically sound cash inflow of $36,300. We just do that exact same reverse engineering for purchases and salaries, and we land at our final net operating cash flow.
All right, jump into Section 4, Operating Activities using the Indirect Reconciliation Method.
This calculation kicks off with the net profit before taxation, the absolute bottom line of the income statement. But since that number is packed with accounting fiction, our very first step is to add back expenses that never actually drained our bank account. The most obvious one, depreciation. If you depreciated an asset by $10,000, your profit dropped by $10,000 on paper, but your bank account didn't change one bit. So we just add that $10,000 right back to the profit to start uncovering our real cash.
Once we've handled the non-cash expenses, we pivot to adjusting for working capital. And hey, if you're taking notes, you'll definitely want to lock this calculation matrix into your brain. Just think about the logic here. If a current asset, like inventory, increased over the year, where did you get it? You spend cash to buy it.
So an increase in a current asset has to be deducted from your profit as a cash outflow. On the flip side, if a current liability like trade creditors increased, it literally means you kept your cash in your pocket instead of paying your suppliers. So an increase in a liability gets added to your profit as an inflow. Once you master this logic, the indirect math is a total breeze. Moving right along to Section 5, calculating, investing, and financing cash flows.
The rules for this part are incredibly straightforward. You just follow the cash. Are you acquiring non-current assets? That's a cash outflow. Issuing shares or taking out a bank loan? Cash inflow. Paying out dividends? Outflow. But, and this is a big but, you have to be super careful. Things like asset revaluations or issuing bonus shares do not involve physical cash changing hands, so we absolutely exclude them from our math. To calculate exactly how much cash was spent or received on those big assets, we once again rely on our trusty T-account ledgers. Check out Galore BHD. Their vehicle balance went from $45,000 up to $68,000. But wait, they also disposed of an old vehicle that originally cost $15,000. By setting these ledgers side by side, we just plug in the opening balance, the disposal cost, and the closing balance. That missing figure you need to mathematically balance the account, that proves Galore BHD must have spent exactly $38,000 in cash on a new vehicle. We run the exact same kind of calculation to find the cash received from a disposal.
And that exact same logic applies to the financing side. Now, a really common trap here is just grabbing the dividend expense straight from the income statement and using that. But remember, that's an accrual. To find the actual cash you paid, use this exact formula. Take your opening dividends payable, add the current year dividend expense, and deduct the closing dividends payable. This specific calculation guarantees we're only reporting the dividends we actually wrote a physical check for, not just what the board proposed.
And finally, Section 6, the final equation, bringing it all together.
When you look at the final architecture of the statement, it's actually beautiful. You simply list out your meticulously calculated net cash from operating activities, add your net cash from investing, and add your net cash from financing. Summing those three pillars gives you your grand total, the exact net increase or decrease in cash for the period. It's a completely logical flow that strips away all that messy accounting noise.
But here's the best part. How do you actually know if your math is right? Cash flow accounting literally has a built-in truth serum. You take that final calculated net cash change and you add it to your opening cash balance from the start of the year. If that resulting number perfectly equals the closing cash balance sitting on your balance sheet, your math is flawlessly reconciled. You have successfully tracked every single dollar.
Which really brings us to the ultimate point of doing all this math in the first place. We calculate this because cash is reality. Think about it. If accrual accounting insists a business is incredibly profitable, but our calculated operating cash flow remains consistently negative year after year, exactly how long can that business actually survive? Mastering these step-by-step calculations isn't just about passing an exam. It's the absolute key to understanding a company's real-world survival. Keep crunching those numbers, focused learners, and I'll see you in the next explainer.